Good morning, good afternoon, good evening, wherever you are in the world. It is my pleasure to welcome you to today's webinar on parametric insurance with Matthew Grant and Henry Gale. My name is Hugh Morris. I'm a senior research partner of Zien, and it's my pleasure to be able to chair the event today. Now, I can only do that thanks to the generosity of our sponsors, who enable us to range widely and freely across technology, economic, and finance. And my job is to get out of the way as fast as possible and enable Matthew and Henry to take us through their materials on parametric insurance, after which we will have about a 20-minute Q&A. Please feed in your questions into the chat, which will relay them to me, and I will then relate them to Matthew and Henry on your behalf. A couple of housekeeping notes. The slides are available to download in the chat and on the website. And at this point, without further ado, it is my pleasure to hand over to Matthew.
Thanks, Hugh, and thanks to all of us, or all of you rather, that are joining us today. We're really delighted to be talking to you. Thanks for giving us the opportunity to talk about a topic that we ourselves find very intriguing. I'm going to pass over to Henry in a moment, just a very brief background about Instech, if we'll give you some context for what we're talking about. So we're bringing together insurance companies and technology companies to understand what's happening at some of the more innovative areas around the world and the companies working on those. My personal background, I came across parametric insurance through my work in catastrophe modeling 30 years ago with industry insurance-linked securities and cat bonds. So I've seen that evolve since then. Henry is our lead researcher on parametric insurance and writes a newsletter on this. We've done some reports on this. And so through Instech, we've got a lot of information behind this. But today, is really to give you a taster. We know, for those of you listening, there's a whole range of people out there. Some of you may be experts in this. Some of you may have never come across it. So Henry's challenge is to make it interesting for all of you, which he certainly will do. But there's a lot more to find out about. And as Hugh said, we very much welcome questions. So with that, I'm going to pass over to Henry. I'll be back for a couple of minutes along the way. But Henry, over to you.
Thanks, Matthew. Yeah, and as you mentioned, some of you may not be familiar with parametric insurance. For others, it might be something you're slightly familiar with. So we're going to kick off with a recap or a first definition of what parametric insurance is on the next slide. Parametric insurance is different from most types of insurance that people have heard of and use. Most types of insurance are traditional indemnity-based. They're designed to compensate insurance policyholders for the loss they experience. So if a policyholder has experienced a loss that's covered by their insurance policy, they make a claim, the insurance company will assess that claim, and if they agree, they can reimburse the policyholder based on the amount of the loss. But parametric insurance, which is also known as index or event-based insurance, pays out claims based on event triggers. So parametric insurance policies set out in advance the event or events which would trigger an insurance payout, and they define in advance how that payout will be calculated. And so if the event happens, the policyholder will receive a payout from the insurer. There's no claims process or assessment in the same way as there is with traditional insurance. And the amount that's paid may depend on various event metrics or parameters. And in most examples, the policyholder doesn't even need to notify their insurer that something's happened to them. Now, it's mostly been used for weather events and natural catastrophes, and we're going to go through quite a lot of examples, or a few examples in our sort of presentation just now. But to start off with, this concept of parametric insurance isn't actually a new concept, and it's been used in the catastrophe bond market for around 20 years, and that's where Matthew's got his experience. So I'm going to hand back to Matthew to give an early example of how parametric triggers have been used for insurance.
Thanks, Henry. And in fact, actually, parametric insurance even goes back longer than that. Life insurance is probably the form of parametric insurance that all of us are familiar with. When someone dies, you get a payout. It's it's a sort of quite a good way to think about the pros and cons of parametric insurance that Henry can touch on. But certainly, in a sort of property and casualty world, for insurance purposes, as Henry mentioned, parametric insurance really came about with the earliest catastrophe bonds. And for those that are not familiar with this, this is essentially an alternative to using the traditional insurance markets to provide cover for large losses going out through investment funds, pension funds, And in the earliest days, we saw examples of companies issuing catastrophe bonds that were triggered by things like the speed of wind at landfall going through certain what they call gates. So as it made landfall over Florida or the eastern US seaboard, if there's a certain wind speed, that would trigger a loss. And those were sort of payouts in the hundreds of millions of dollars. Those continue to be used in those sort of larger scale, but most of what we're talking about today is going to be a slightly smaller scale of parametric, and that's where the growth has been. We also saw probably 20, 25 years ago some quite innovative use of parametric, and examples there where Disney was protecting its facilities for wind speed losses. After Hurricane Sandy in New York, the Metropolitan Transit Authority put in place a catastrophe bond for flood levels, so that in future, when there was a flood level or a flood coming into New York, there'd be a payout based on flood depth. And then also another notable one is Golden Globe, Golden Goal, sorry, which was around the World Cup. So if there's a cancellation for the World Cup for different reasons, that would have paid out. So as Henry says, got a long history, very well validated, and crucially, of course, for any insurance transaction, the proof is, did it pay out after the event? So there's been a few situations where these have also triggered and paid out and been demonstrated to work, albeit, you know, with some lessons along the way for what it takes to design a quality parametric index that does as it suggests on the offering. So Henry, back over to you to take us to bring us up to date on what's available now.
Yeah, definitely. And on the next slide, we sort of look at how that principle from catastrophe bonds has been extended to commercial lines insurance, saying, you know, a hurricane insurance policy based on wind speed. You know, that's something that has been done for the largest companies, largest corporations, and for insurers buying reinsurance with catastrophe bonds. But companies like New Paradigm Underwriters, which was founded in 2013, have developed ways of bringing this to a wider market for all sorts of commercial businesses. So they offer parametric policies that pay up to $50,000 for smaller businesses, and for the largest businesses, they can also offer parametric policies with limits of $5 million or more. And its clients include hotels, golf courses, real estate owners, as well as insurers who can buy reinsurance from New Paradigm. And they use wind speed, as I mentioned, as their trigger, and you get a different payout depending on how fast the wind in the hurricane is at the location where that hotel or whatever the policyholder is. Now, one of the challenges they had to solve here was, where are you going to get this wind speed data from? Because normal wind speed recorders actually just blow away in hurricane force winds. And New Paradigm actually relies for its trigger on a network of over 100 hurricane hardened anemometers on the US East Coast. You can see one of them on the slide here. And so they're on steel reinforced concrete poles. I think you need 2 trucks, is that right, Matthew, to install them? It's quite an extraordinary device. So these new sources of data and this new technology is what's enabling parametric insurance to be distributed and be available more widely. So for those clients of New Paradigm, especially hotels, parametric insurance is really helpful because it can cover things that might not be covered under their traditional insurance policy. For example, all of their outdoor assets or golf courses might be excluded or really expensive to get coverage for. And that's where parametric comes in. So on the next slide, there's sort of a comparison, or, you know, what is the difference between traditional coverage and parametric? Well, one of the advantages of parametric is that there's a reduced claims assessment process. As I mentioned, once the wind speed has been recorded, for example, then the payout will happen. There's no forms to fill out, or at least much fewer forms. And that means it's cheaper for the policyholder and for the insurer. And as a result, you get a faster claims payout. The payout could be calculated in hours or days, sometimes even in real time, instead of weeks or months. So the claim is paid more quickly. And especially for some of those large catastrophes, claim payments can take quite a long time otherwise. Another benefit is transparency. Because the policyholder and insurer have to agree at the start of the policy how the payout will be calculated, that can be quite appealing to policyholders, and it might reduce disputes later on. But there are also disadvantages. With parametric insurance, you're likely to have some sort of basis risk, which refers to the difference between the policyholder's actual loss, the physical loss that they've experienced, and the payout that they're going to receive. Now, this is also a problem with traditional insurance, where there will be deductibles and exclusions that mean you don't get your full insurance payout. But with parametric, the insurer and the policyholder have to work quite hard at the start to make sure they are setting the right trigger so that there will be a limited basis risk. It's also worth mentioning that most parametric policies only cover one peril, like hurricane, or maybe two perils, and so it's not an all-risk policy. If you've got parametric hurricane insurance, it won't help you if there's a fire or a break-in or anything else. It's also not widely understood. It's a new product to customers. It's a new product to most of the insurance industry, although understanding of it within insurance is really rapidly growing now. But this does increase the cost associated with explaining the product. And so as a result, we find that parametric insurance normally complements indemnity-based traditional insurance rather than replacing it. It's normally meeting gaps. So in that new paradigm example earlier, it might be meeting a gap where outdoor assets are excluded from their hurricane insurance. And we'll go on to some more examples of how parametric can fill those gaps later on. But we've got a couple of slides now that look at how the parametric insurance market has changed. Lots of startups like New Paradigm, as Matthew mentioned, have entered the market in recent years, offering parametric insurance to a wider audience beyond reinsurance, beyond catastrophe bonds. And this chart tracks some of them. So you can see that many parametric companies have been set up in recent years. The next slide looks at funding, and you can actually see there are some private deals which aren't in there for the last couple of years, but since 2020 there's been a really large, hundreds of millions of funding has gone into the parametric insurance market, those startups and scale-ups. And one of the companies that's received the most funding is a company called Descartes Underwriting. We've got a case study with them on the next slide. They offer parametric insurance to especially corporates and the public sector and other businesses. And they're focused on parametric covers for a range of natural catastrophe and weather events. And one of their clients is an energy company in India that had its offshore jetty destroyed in 2019 by a cyclone. And under the insurance it had before, a traditional insurance solution, it actually didn't get a claim paid for 2 years. It had to wait that long for its claim to be settled. And that's why it really saw then the benefit of parametric insurance and having a faster claims payment process. They took out their next insurance policy with Descartes Underwriting, and that policy was based on wave height. So whether it would be a cyclone or a tsunami, whatever peril that was going to come and have waves destroying their jetty, there would be a payout more quickly. And actually, when there was a cyclone 2 years later in 2021, and the company's marine assets were completely destroyed, they received their insurance payout just within a few days. So that's one of the examples of where if you get the trigger right, you can see a real benefit from parametric providing that faster payout. On the next slide, we've got an example of parametric insurance being used by the public sector. The government of Mexico actually has purchased parametric earthquake insurance from Swiss Re, a big reinsurer, to protect various cultural sites in Mexico, and that includes the pyramids of the sun and the moon that you can see here. It includes the Metropolitan Cathedral in Mexico City, and actually over 1,000 cultural assets across the country of Mexico are covered. And the policy pays out based on earthquake shake intensity, I believe, as calculated by the US Geological Survey at pre-agreed locations. So if the shake intensity is more than a certain amount, that is going to trigger a payout, and that can be used to restore those cultural assets. And the government of Mexico went to Swiss Re for this parametric solution because they really couldn't find the right traditional insurance solution. Traditional insurers found it very difficult to quantify how much the loss would be and how much the repair costs would be, and squaring all of that with earthquake was very difficult. And actually, parametric insurance was where they were able to find the right capacity they needed to protect these assets. So that's another example. We've got another earthquake example next, actually, which is quite different. because you can also get parametric insurance for individuals as well as for companies and the public sector. Super is a startup that's offering personal lines parametric earthquake insurance in Mexico, and they actually made their first payout in September 2021, 3 days after an earthquake is actually pictured here. And they offer insurance basically to anyone who might be a homeowner or a renter and could suffer losses from earthquakes. You can get limits of up to 500,000 pesos, which is about $25,000. And there are other startups as well offering similar products, earthquake insurance or hurricane insurance, to households in the US and New Zealand. And we think actually Super is the first time that a household anywhere in the world has received a parametric insurance payout after an earthquake. Another key use on the next slide is in the agriculture sector. So if you're growing crops and there's too much rain or too little rain, or temperatures are too high or too low, that affects yields and revenues greatly. And you can buy insurance against this using parametric triggers. So there's all these various data sources using satellite imagery or publicly available data. And there are companies such as Arbol which offer this sort of coverage for different crops based on different triggers and different parameters that can be customized. And it also includes things like hurricanes, wind speed, floods, other natural catastrophes. But there are non-catastrophic weather events, as I mentioned, like temperature and wind and rain, which are really important to agriculture. And so they're able to structure any number of parametric triggers for farmers across the world. It's also important for renewable energy companies, because there are wind farms that rely on a certain amount of wind speed, or solar farms that rely on solar radiation, and you can structure parametric products for solar farms that use solar radiation or cloud cover as a trigger. And that's another example of parametric insurance for that industry in action. So it's worth saying that natural catastrophe and weather-based coverage is sort of the main type of parametric that we see out there in the market and being purchased at any scale right now. Hurricane and earthquake and some of those agricultural applications being the biggest ones, and particularly for those hurricane and earthquake perils, it's North America that is and the Caribbean, the main areas where parametric deals are being done. And the majority of parametric uptake so far has been with those larger corporate or public sector clients buying millions of dollars of coverage, rather than with individuals so far just buying maybe a few $1,000s of coverage. So that there can also be larger deals than that. They tend to go into the catastrophe bond market, or they can be syndicated between different insurers. We've also got the next slide, which is about filling gaps in coverage. So in some cases that we looked at, those examples, parametric insurance was sort of replacing indemnity-based policies, and that is what is called carving out a covered peril. So if you think about, I'm not sure the exact, the exact terms of the Descartes policy in India, but that jetty company could have actually decided we don't want any cyclone insurance from our traditional insurance policy that covers that. We're just going to get a parametric policy to cover cyclone exposure. And so you can exclude one peril like cyclone or hurricane from your traditional policy and carve it out so that it's covered by parametric. Some of the other common ways in which parametric can fill the gaps is as an add-on to cover traditional exclusions. So a hotel might have a hurricane policy with its traditional commercial property policy, but it might not cover their outdoor assets or golf course, or might not cover their business interruption losses. And so parametric insurance can be structured to cover those additional things which are excluded. The other ways are if you've got a very low limit that's available on your policy, say for something like hail damage, which is really difficult to insure in the US at the moment, you can use a parametric policy to cover exposures that might be above that limit. So maybe you're a solar farm, for example, and you might only be able to get a limit of 1 or 2 million, but you've got tens of millions of exposure. You could use a parametric policy to cover some of that extra exposure. And conversely, if you've got a large deductible, maybe it's for something like tornado, where parametric policies have also been done. It could be that you've got a deductible of 2 million on all tornado losses. Most companies aren't going to want to retain that amount, and so you can actually use a parametric policy with a limit of 2 million to cover that loss, which would otherwise be retained by the company. So we're about to hand over to questions, but the last things I want to say are we're seeing some early examples of combining parametric insurance and indemnity insurance in a single policy. Traditionally, it's been you buy traditional insurance and then you find a way to add on parametric. It might be structured together when you're talking about renewal for catastrophic risks with your broker. But we're now seeing some early examples where it's all packaged in one policy, trying to combine the best of both with a parametric cover for certain aspects or maybe immediate expenses and indemnity-based insurance for other aspects. And in all cases, parametric insurance is not limited to physical damage. It's not limited to weather and natural catastrophes. In fact, you could almost create a parametric policy for anything that has a data source. But where parametric insurance is successful, it's solving a real customer need, right? A new parametric cover doesn't come from finding a fascinating new source of data and looking at an interesting way to use it. It comes from identifying an area where existing insurance options are inadequate, or maybe they're simply unavailable. And that's what some of those case studies we looked at earlier were about, where the companies, frankly, they couldn't find the right insurance. And so that's why they turned to parametric. That's where parametric is coming in and filling that gap. So yes, I mean, that's sort of what we wanted to present. I hope that's a useful introduction to parametric insurance. We've got some more resources here, a report which we published last year, which looks at a comprehensive look at the parametric market. And we've got a newsletter that comes out every 2 weeks with the latest case studies and news. And many of the companies we mentioned, in fact, I think maybe all of them, have featured on Intertech podcast episodes hosted by Matthew or myself. And that's another way that you can learn some more about these companies. But I'll hand back to Hugh to ask us what questions we've had from the audience.
Matthew, Henry, thank you very much indeed. A truly fascinating subject, a very different way of looking at insurance. Yeah, we've got some great questions from the audience. So let me kick off. Thomas Barker asks, do you think that smart contracts and blockchains will have a part in the future of parametric insurance markets, or are they just a bit passé now?
Yeah, it's a great question. So smart contracts do have a role in the parametric insurance market. I mean, when you think about parametric insurance, it should be able to be triggered by something independent. And yes, in theory, you shouldn't need the insurance company to even look at the claim payment. It could be almost completely automatic. And actually, the company Arbol that we mentioned in that presentation, they do use blockchain technology and smart contracts. But the other companies mostly don't. There are some other companies out there that do use smart contracts. I think parametric insurance is a very compelling use of smart contracts, but smart contracts are not necessary to achieve parametric insurance, because you can also have other systems of automated payouts. And in some cases, for the largest deals, there may need to be some, for regulatory reasons, there might be some reasons to have forms involved or confirmation of loss, and that insurance companies may not always be comfortable with having a blockchain triggered solution, especially when it comes to very large amounts being paid. But yes, so smart contracts can be used, and they are used, but they're not absolutely necessary to the growth of parametric insurance.
Thank you very much. It's obviously a very different set of triggers that cause claims to occur. Have you seen examples of where the parametric triggers perhaps don't work as intended?
Yeah, there have been a few examples, and some of the most public ones, I guess, are in the catastrophe bond market. So there was, talking of a sort of non-physical peril, if you like, the World Bank structured a catastrophe bond for pandemics, and they used a parametric trigger for that based on, I think it was various metrics to do with when it was declared by the World Health Organization, or the number of deaths or cases and those sorts of things. And they actually found that bond, which I think they may have structured in 2019 or 2018, when it came to the 2020 COVID pandemic, it didn't pay out as early as most people expected. It did get triggered, but the bond was designed to provide some immediate financing to poorer countries to help them manage their response to that pandemic. And in the event, when it triggered, I think, in May 2020, that was seen as too late by a lot of people. So lessons have been learned from that, because parametric pandemic insurance is still being done on a small scale, but there have been lessons learned from that in terms of how you're going to get the payout to come at the right time. There was also been insurance policies based on drought and agriculture. If you don't know exactly what crops are being planted in certain areas, and you don't know how they'll be affected by certain weather perils, you can set your parameters wrong. And once you set the parameters wrong, you may find that a farm can experience, a big loss without the payout being triggered. So that's another example of something that's happened. I don't know if Matthew, you've got any more. Or...
Yeah, sorry, excuse me. The thing I think Henry touched on, but the big risk, I think, and often the reason that parametric are hard to sell is what's known as basis risk, which is that the payout doesn't correlate well with the financial loss. So that's, you might see some payout, but you might find the person or the company doesn't get paid out in full. I think that's what we're seeing. And then the examples. In a sense, the sort of basic rule is the simpler the index, then the more effective it is, because as soon as things have to be calculated separately, or they rely on different indices, or they rely on indices that might not be very reliable, then that's where the risk of failure comes from.
Cool. Thank you very much indeed. So Clive Bullen asks, obviously insurance companies want to make a profit. Is parametric insurance likely to be better for that profit or not?
Well, I mean, it can result in reduced expenses for insurers, because the models that they have to use for parametric insurance are different. They don't have to model the vulnerability of a building. They only have to model the likelihood of a peril. And particularly in the claims process, there's much less friction involved there, and there's less need for human intervention and fraud detection and all of those sorts of things, depending on the type of policy, of course. So in some ways it can reduce costs for insurance companies, but there's a larger upfront cost in terms of structuring the policy, and as I say, getting the policy right so that there will be no basis risk, and that can involve quite a lot of conversations with a broker. I'm sure Matthew will have more views on this question as well.
Yeah, I mean, the other side of it, of course, is that one of the big drivers of the interest in parametric is to sort of fill what is known as the insurance protection gap. So parametrics are really best used where, as Henry sort of mentioned a few times, traditional or conventional insurance doesn't work or is too expensive. And so from the insurance point of view, this is what you see happening, particularly in Lloyd's. There's quite a few syndicates, managing agents supporting parametric because they see opportunities to give new cover. And some of the unusual ones out there are organizations like Gaia that are providing cover for IVF treatment. So failure of IVF treatment pays out. That wasn't insurable before. There's Parcel, which was providing insurance cover for the transport of medication and vaccines. And so if they go above a certain temperature when they're in transit, because many of these needs to be refrigerated, then a sensor sitting on top of the box of medicine changes color, and it's clear the temperature has been breached and there's immediate payout. So I think it's the question, the biggest opportunity, and frankly also insurance's ability to do more social good is cheap insurance, cheap to distribute, cheap to, as Henry says, to pay out. It fulfills a need, and it allows the organizations that are sort of willing to go into this and back some of these initiatives with capacity to actually have some quite significant growth areas. So that's why we see in this acceleration. And I mean, I think we was 150 companies. I think we're now tracking, offering parametric analytics or insurance in some way, and that's just going to keep growing.
Thank you. Let me throw in a question. So if parametric insurance can potentially pay out to policyholders when they haven't experienced a loss, can it really be a regulated insurance product?
Well, I mean, that has been one of the challenges in starting to expand parametric insurance to consumers and to businesses, and but generally, actually, regulators have found a way to become comfortable with it, and it does vary in different jurisdictions. Sometimes there will be an intermediate step in the claims process where, for example, after an earthquake, you might receive a text message saying, "We can see you're eligible for a payout. Please, can you confirm you've experienced a loss?" You text back yes, and then you get the payout. It's very different to a normal insurance experience, but it's still got that aspect in which policyholders do need to confirm they've had a loss. And for those large corporate deals, in various cases, there might be a similar thing where they sign a form to say, "I have experienced a loss that is, a similar or the same amount as what I'm being paid." But there's not normally the same requirement to produce all documentation to prove that loss. And in some cases, you might be able to do that confirmation even after the payout has happened. So it varies based on different jurisdictions, but generally, well-structured parametric products will be accepted by regulators, and there are lots of people who have done it already in different jurisdictions, and they've spent the time talking to regulators, getting them comfortable with the product in order for more products to be released in the future. The other one I'd say on that is parametric insurance often is not covering the full extent of someone's losses. So if you think about that super earthquake example, someone's home is likely to be worth more than $25,000. So if they receive that payout after an earthquake, it's probably going to go mostly towards covering some of their immediate expenses rather than the whole lot. And that's also the case if you use it to cover deductibles or other losses for companies as well, or business interruption losses. So it's not always a physical loss that it's covering, and in most cases it's not the whole loss. So that the risk of parametric paying out more than someone's lost is maybe smaller than you'd think, but also there are different ways to confirm it and get around that issue so that it doesn't happen.
Just add one more into that, which is there's some quite interesting things happening now where organizations often linked to government funding agencies. So Global Parametrics is looking at doing this, where they're actually creating a structure that pays out before an event happens. So for example, if a hurricane, and this is actually a case study they looked at, a hurricane or cyclone about to make landfall in the Philippines, if money can be made available to people that are potentially going to be impacted by the hurricane or the cyclone, they can then do things such as board up their houses or move vehicles, or just reduce the risk. And so you get a much more effective way of deploying aid if you can give it to people before they get hit than afterwards. Now that's got quite a lot of challenges with it. Clearly that is almost certainly not an insurable way of doing it, but it's a similar mechanism to parametric, all being done through a different funding mechanism, in which is starting to see some successes.
And to be clear, that's a live example that actually did pay out during Super Typhoon Rai in 2021, I think, in the Philippines. So in those cases, it's not always a regulated insurance product. It might be a form of aid, or it might be a financial derivative. So there are different ways in which you can structure parametric. It's not always insurance.
Yes, Alan Punter suggests that parametric insurance is really a derivative contract, and he's asking, does that give rise to any particular regulatory issues?
Well, in most cases, parametric can either be structured as a derivative or an insurance product. The key difference is that with insurance, you have to have insurable interest. But if you can prove that there is an insurable interest, there are companies out there that structure this mostly as insurance products rather than derivatives.
Peter Hall asks, are the algorithms involved impartial as between different groups in society, or is there a risk that some people will find themselves excluded from this type of insurance?
I'm not sure I fully understand the question about impartiality. I mean, there's data which often comes from publicly available sources that can't be manipulated, but I'm not sure if I quite get that point about exclusion.
Actually, Henry, sorry, you go on.
Carry on.
Yeah, no, I mean, I think there's two parts to that question. I think there's one, what is known in insurance terms as redlining. So, does it mean that certain people are going to be excluded from insurance because they're at risk. I think that's one. And then secondly, is there something in the way the index is calculated that can sort of bias certain people? So I mean, certainly insurers have in some cases, a regulatory requirement to offer insurance to everybody that's there. Parametric, almost by definition, is to be offered to what we know in the UK as a sort of excess and surplus market, or non-admitted for the US market. So in a sense, it is targeted at a certain demographic. There are cases across the world, particularly in Africa, where there's some quite elegant solutions using things like farmers buying seed that had an insurance package built into it that was intended to benefit all aspects of society. I think the algorithms themselves, I think it comes back to the point, the benefit of this is because it is purely a physical loss. It shouldn't be influenced by an individual's actions. Now there are cases that might be the case, but it's about flood depth or wind speed or hailstone landing on a sensor. So in a sense, it is a very pure form of repayment, because you're just looking at what happened externally, and provided your mechanism for tracking that is robust, then it should be a very effective way of paying out, and it shouldn't have to be concerned about bias in the algorithms.
Thank you. Rowan Minos asks, do you think that Parametric will play a huge part in ESG? For instance, there are solutions in New York that currently provide financial injection to households when they suffer a natural disaster to mitigate the loss that low-income households face.
Yes, there's quite a lot of ways in which, as Matthew mentioned just now, parametric insurance is being used to improve inclusion and to drive resilience in low-income communities. And I don't know if that's what the question was mentioning, but there's a pilot project for parametric flood insurance in New York at the moment, which is being run by community organizations and being reinsured by Swiss Re with various other companies, using satellite data to understand how is a flood impacting this community and distribute payouts around it. But there are also aspects in which parametric insurance can really create new types of insurance that haven't been done before to support the environment. So there are actually quite a few examples of policies for marine ecosystems, coral reefs, oceans, that if they're damaged, you can have a parametric policy based on triggers such as cyclone wind speed, or sea temperature, algae blooms, all of these various things that can happen to underwater ecosystems. And these things actually can often cause oceans to lose their carbon sink qualities, i.e. they would absorb less carbon dioxide from the air after a cyclone's happened, or after rises in sea temperature. And so you can structure parametric insurance that enables a quick payout to restore that ecosystem and effectively allow the ocean to absorb more carbon dioxide, and that's a great thing for the environment. So there are various ways, and particularly those environmental and social aspects, that parametric insurance products have been implemented to improve that. Have you got any more you'd like to add to that, Matthew?
Yeah, so the network, I think my network was a bit choppy. So can you hear me all right, Henry?
Yep.
Yep.
All good.
No, I think I got most of my. Yeah, let's keep back to you.
Very good. I think we've time for one more question, and perhaps my question would be, seeing this as it's clearly been around for a while, but it's also clearly a growing sector of insurance. In 5 years' time, do you think this is going to be displacing substantial indemnity insurance as a major part of the market, or will it remain the insurance equivalent of a minority sport?
Well, I think it is still a niche solution for certain types of risk. It's becoming more mainstream, and I think it will probably continue to grow in use for some of those most difficult catastrophic risks. But I think there are different ways in which parametric insurance might be experienced by consumers. It probably won't be lots of people choosing to buy a parametric earthquake insurance product or for their own home, but it might be adding in that type of immediate parametric payout to existing insurance products that they have, and that could be in home insurance, but it could also be in other aspects. One we haven't talked about is travel, where you've got companies like Blink Parametric that are enabling insurers to have automatic parametric payouts after someone's flight is delayed or after they're cancelled, for example. So there are various ways in which parametric insurance, is likely to become more prominent, but it's not going to be, completely, removing and replacing the traditional insurance products that we know and use.
I think I've got a minute to add to that. Actually, I mean, I think what's interesting, the sort of hyper localization, meaning the very sort of down to the individual household level. So I think what we're going to see more of is, what does the individual householder or business do to protect against a natural hazard? And so that will compensate or replace where some insurance companies are now less comfortable about providing hurricane loss or flood loss or wildfire loss in certain areas, or certainly providing as much coverage. If the individual can demonstrate they've taken precautions, then that may well be a way it'll fill in that gap. So I think to Henry's point, yes, it'll still be or your terminology here, a minority sport, but I think it's going to be we're going to see more and more volumes of premiums being written through Parametric year after year.
Well, that has been an absolutely fascinating exploration of an extremely interesting subject. As I draw this to a close, I would very much like to thank our sponsors for enabling us to put on this and other webinars. I'd also like to thank the audience for extremely attentive engagement and some very interesting questions. There are continuing series of the webinars under the FS Club banner, and I put the next few on the screen there, which I commend to everybody. And I would, of course, very much like to thank Matthew and Henry for giving us their time and sharing with us their insights and thoughts on this extremely interesting subject. And I wish you all a very good day, good evening, good night, wherever you are in the world, and thank you for attending.